Hello and welcome back to New on the Block with me, Leah Heilpen. Now we are very thrilled to be joined with Simon Dixon, CEO and co-founder of Bank to the Future. Simon, great to have you. How are you doing today?
Yeah, very good. Thank you. Thanks for having me.
Good, absolute pleasure. Now, we'll jump straight in. We have a lot to discuss. Now, people say regulation will actually incentivize major institutional investors to actually start investing in crypto companies. Do you agree, and why?
Well, there's two tiers to the market, and both are important markets. One is the institutional side. Now, institutions have to adhere to very strict regulations. They have fiduciary duties. They have to custody funds in the correct way. They can't just lose money. They have people's pensions and insurance and all sorts of things on the line. And so they have to adhere to a very high standard. At the same time, Bitcoin and crypto and all sorts of assets that have come as a result of this industry allow for people to own their own assets and own their own money and hold it on a hardware wallet in their own possession. So you have these two-tiered markets. One is person to person, where you take full responsibility and there's no regulatory oversight or control needed in you owning your own assets, other than you adhering to your tax regulations or whatever you need to adhere to as an individual. And then you have an institutional market. In order for the institutions hold a lot of money, individuals hold a lot of money, but the two come hand in hand. And by opening up regulations, you open up the second market, whereas predominantly it's been done at the individual level up until now.
But Simon, I do just want to understand that correlation, that connection between regulation and major institutional investors actually jumping into the space. What is that correlation?
So regulations you have different types of regulations. You have individuals that are retail that don't have a significant amount of money, and they are allowed to invest in certain products, but they have additional protections from regulations. You then have high net worth individuals, which can opt out of investor protection, which opens up a lot more investment opportunities as a result of not requiring additional investor protections and costing taxpayers money for regulators to enforce certain regulations on high net worth individuals. You then have institutions, and institutions are pooling together other people's money to invest, and they have to adhere to certain regulations depending on where the pool of money is coming from. If it's pensioners' money, they have to adhere to different regulations versus if it's insurance money being pooled together. So you have these three different markets, and they open up different regulations and different pools of money as they get unlocked.
So let's just get some more information around this, because what will major institutional investors, what will their investment actually do for this space?
Well, it brings in a lot of long-term patient money. So a pension fund is not looking for a quick return. Somebody speculating on a cryptocurrency short-term on an exchange is maybe looking to leverage up and get a very quick return on a high-risk basis. What this does essentially is, depending on how the investment product is actually structured, is it can actually suck supply. For example, Bitcoin has a fixed supply, and therefore if institutions started investing in Bitcoin or products that are backed by Bitcoin, it means that that's long-term patient money, and the supply of available Bitcoin decreases, and therefore the only way to get Bitcoin is to pay a higher price. So it adds a new pool of money, which affects the supply and the economics of these cryptocurrencies.
And I think that the space right now, due to a lack of a regulatory framework, has actually led many to refer to the space as the Wild West. So what do you think companies actually need to do when actually considering investing in crypto companies?
Well, it is very much a do-your-own research, buyer beware market. It is full of scammers, it is full of problems, but at the same time, it's bringing about radical change in our financial system, the ability to own your own money, spend your own money, and monetary policies that are independent of politics. And in times of political turmoil, it gives an exit to people from the traditional financial system, at the same time as providing economics that the government cannot simply provide, creating one of the most radical shifts in financial history that we've ever seen. At the same time, there's scammers out there that want your money. When you give people the ability to own their own money without a bank, you give people the ability to try and scam that money out of you if you don't understand how to secure it. So it's a shifting trend. Just like when social media came along, it brought the opportunity to connect the world globally, but it also infringed upon our privacy and allowed companies to sell our data and have a record surveillance. It comes with a pro and a con, but it's a shift that is inevitable, predictable, and guaranteed in my perspective.
So it definitely comes with a price. Obviously, you've just mentioned quite a few there. But in terms of the main benefits, what would you say the benefits are for actually investing in the industry?
Well, I believe that we're in the midst of the disruption of a multi-trillion-dollar industry. I think that we're in a record economic experiment with countries all around the world. At the same time, financial institutions, banks and retail banks operate within a very Ponzi scheme-like market where it is all based upon debt, and the debt cycle is coming to an end. Therefore, people are going to have to start looking at alternatives. Traditionally, they've looked at gold, but now we have a financial system that can operate and exist without financial institutions, without governments, and without central banks. Now, that is the first time that we've ever had that. So the opportunity for people to start hedging and understanding their exposure to traditional financial markets and have a choice and have an exit and have the ability to actually own their own money in a self-sovereign way brings about with it a freedom that we've never experienced and an opportunity to invest in the disruption of what I believe will be a multi-trillion-dollar market. We haven't seen disruption in traditional finance for decades. It's been kind of the same types of players, but this is the first time we've seen it at the currency level, at the financial products level, at the capital markets level, and that's why it's producing an unparalleled amount of investment opportunities for the brave and the willing to accept some of the risks and challenges that come with it.
Multi-trillion-dollar change there, and you talk about this disruption. It all just sounds so revolutionary, and it really is quite something. But in terms of people being self-sovereign, and like you said, this really is the first time until we get a good regulatory framework being rolled out. Although we've mentioned all these incredible benefits, what can crypto companies actually do to assure investors that their funds are going to be safe?
Well, we can do what we've been doing right now, which is self-policing and self-regulation. There is, crypto companies are held to an incredibly high standard by the social universe, the Twitter universe. Really it's about self-regulation and developing technology that disrupts regulation. Cryptocurrency and blockchain technology regulates the regulator once the technology fulfills its promise, because it takes out the need for certain regulations. For example, you can do things in a self-custodial way, which means that the middle people don't need to hold client money. And when you don't need to hold client money, then you can't lose client money. So it brings about opportunities. Another example is people owning their own identity takes away the opportunity for companies in the middle to have people's data hacked. But at the end of the day, it puts the responsibility on the individual. So it's a shift to change. And we need self-regulation in the meantime, because the technology will out-innovate anything a regulator can produce. And that is the challenge. Whenever they enforce regulations, it tends to be for outdated thinking, because this market moves faster than any human can think.
And I think you make a really fascinating point there when you talk about the Twitter universe, because with a lot of scandals that we've seen recently, it definitely, the Twitter immune system definitely comes in and attacks whatever might be disrupting the space. So that very, very spot on there. And I think, Malta is actually leading the way with the regulatory framework, and many are hoping that it will eventually be adopted by the EU. So if this is the case and the rest of the world does follow suit, do you think there's a potential for too much regulation? Because of course there is that push for it at the moment. Do you think we're going to get to a place where it's just too much regulation, especially for such a new and emerging space?
Yes, and that's what always happened. If you look over time, what tends to happen is a new disruption comes along. That leads to somebody losing money. Those people that lose money then complain to regulators, and then the government says to the regulator, why didn't you protect the consumer? And therefore they implement more regulations, and then over time more and more regulations come about as every problem emerges, until eventually you reach the point where lots of middle people are all charging money and regulations become a business, compliance as a service. That happens continually over time. What's different in this space is that we have the opportunity for the technology to actually self-enforce many of the regulations so that you don't actually need the regulator in certain use cases. And that's the really interesting opportunity that we've never seen before, where you can actually enforce it by code. And so that is really where people should actually be looking. How do we not need to trust people to actually have an auditor on top of them, when you could actually use the code and enforce it by the actual protocol in a trustless system, just like Bitcoin brought to this world when it first created a way of organizing a monetary policy without a central bank or a government.
So tech actually self-enforcing those regulations by code, something very fascinating that I don't think we've seen a lot of just yet. So that's a lot to look forward to. Very, very brilliant there. Now, do you see specific countries or parts of the world where major institutional investors are actually more likely to be investing in crypto companies?
Yeah, I mean, so what we're seeing is a lack of opportunity for investors to invest from the US. Part of what we did at BnkToTheFuture.com was make sure that we put together a structure whereby US investors could actually invest via a compliant structure, and same for EU. And that's one of the things we've been doing, is putting together structures which opens up to the broadest market possible in line with securities laws and different laws around the world. But I believe that countries' policies on how they actually shape their policy of how they're going to regulate is going to dictate the future. We've seen different policies. So, for example, Japan has very much decided that they would like to actually, almost treat Bitcoin as a medium of exchange, legal tender, within their country, and therefore they're adopting their policies to support that. And it's a smart move for them because they want to try and get the tax collection. Then you've got countries like China, which have outright banned exchanges, which I believe will lead to a pivot, because all they've done is made people operate in the peer-to-peer market and not able to collect any of the data that happens when you go via a regulated exchange. Then you've got countries that are seeing the opportunity, like Malta, Isle of Man, various other countries, which are looking at the opportunity to create niche, fit-for-purpose regulations in order to create jobs for a new economy. And do it in an environment that's supportive and can offer the infrastructure. I believe that last countries to move will be the ones that have the most to lose. For example, those that are the most dominant, such as dominant currencies like America with their US dollar, or Europe with their euro, or England with their Great British pound, because they have the most to lose from disruption in the short term. And so therefore they will probably be a game theoretical situation where the biggest countries that have the most to lose will be moving last, and the small countries will move first because they see a bigger opportunity. And we could end up seeing one of the biggest shifts in power that we've seen in decades.
How fascinating, the biggest shift in power. Just so much exciting stuff to look forward to, just to see how this is all going to play out. Now, just slightly moving on, many big players have actually done a U-turn on crypto. For example, Jamie Dimon of JP Chase, and then they brought out their own coin. So I want to understand this, you could call it hypocrisy, or whatever you want to call it. What does this actually say about the space?
Yeah, Jamie Dimon is a troll on our industry. He's the CEO of JP Morgan. He has the most to lose because the JP Morgan has so much entrenched power in the financial system, particularly after the financial crisis, when they blackmailed the public and the government to actually bail them out and keep them alive, while other firms went down. And obviously they have a lot to lose from Bitcoin succeeding. So Jamie Dimon, when he first started calling Bitcoin a scam, he got record levels of attention, and people are playing upon that. But now what people are doing is that they're trying to do exactly what happened when the internet created massive disruption. What all of the large corporations initially tried to do was to create their own version of the internet. They called it an intranet. and an intranet was a walled garden that they controlled, but nobody used the intranet because it was too painful to uphold, and they used the open source internet instead. That's exactly what I think we're going to see. The financial reaction initially was to laugh at us, to mock us, to ridicule us, and now they're all jumping on board, trying to control it in their own closed walled garden by creating their own cryptocurrency. But then they're going to realize that nobody wants to use that because the real power is in the cryptocurrency that nobody actually controls, that's open, that's borderless, that allows you to earn your own money, spend your own money, and a monetary policy that is not subject to crony capitalism and everything we've seen from JP Morgan as leader of, in the crony capitalist financial system.
But just off the back of that, I do just want to push you on one particular story which has come out recently with regards to Warren Buffett and his comments on, I think it was Bitcoin being called rat poison. So Justin Sun, founder of Tron, is going to have a very, very expensive lunch with him. So do you think we're going to see a U-turn from Warren Buffett, or do you think he's going to stick with his guns?
No, it's kind of a couple of forces at play here. So the first is that Warren Buffett is fully invested in the traditional financial system. Pretty much half, I don't know the exact stats, I could dig a bit deeper and find them, but Berkshire Hathaway is, I think, 40% invested in the traditional financial system, including being the bailout of Goldman Sachs and many Wells Fargo and many traditional financial systems. So he has a huge vested interest in maintaining the status quo. There is also an intergenerational gap that is occurring right here. Those that are not so used to using technology and adjusting to change find it very hard to accept that there might be change in a financial system that has not changed for centuries. And so we tend to find that those that are subject to less embracement of technology and change find it very hard to accept that you could have this open financial system that exists on the internet. But Warren Buffett is of that generation. He may be incredibly smart at investing in the traditional sector, but just because you're smart at investing in one industry doesn't mean that you can't be at the wrong end of a trend. And I forecast that Warren Buffett, at the end of his career, is probably making one of the most dangerous, problematic financial mistakes he's ever made. But he's cemented his wealth, and he's trying to maintain the status quo. So that's exactly what you'll see with people like Warren Buffett.
And I think you make a point which essentially just, it seems to be the theme throughout here, where you say it's the people that have a lot to lose which will be the last ones to jump on board, essentially, because like we said, he does have an invested interest in sticking with the status quo. Now, Simon, just finally, just to finish, how long till we actually see more companies investing in the space?
Well, we're seeing a lot of investing in this space. So at BnkToTheFuture.com, we've got record levels of investment. We've seen about $740 million invested in companies that are building the future of finance. We funded approximately 120 companies. 6 of those have become unicorns, rather. A few of them have gone down in the industry, but we're seeing, the level of investment increasing at a higher and higher rate. We're also seeing many of our portfolio companies, like cryptocurrency exchanges, like Bitfinex, like Kraken, like Bitstamp, and many others. Their volume is increasing at a higher rate each year. We had a bit of a cooling down in 2018, which was much needed because many of our portfolio companies just couldn't keep up with the demand of the huge number of customers all around the world that were onboarding into crypto, taking their fiat money and looking for an exit opportunity. And our industry just couldn't keep up with backlogs and backlogs of the entire world looking to onboard into this industry. We needed the cool down. But it looks like we're at that stage now where we might have a little turnaround and move back to business as usual, with all the companies being stronger and a much stronger position in order to onboard the world into this new financial system.
Simon Dixon of Bank to the Future, thank you so much for joining us on the program today. It's been an absolute pleasure having your expert opinion on some of today's biggest stories. Thank you.
Thanks for having me.
Now, that is all from us here at Blocks Live TV today. You can get in touch with us on social media. It's at Blocks Live TV, and you can give us your thoughts on today's stories and, of course, on today's interview. But for now, we'll see you tomorrow.